line method. How was the depreciation determined? It was determined by the assumption that every year there will be equal depreciation. Right? We divided up the total depreciable cost equally between all the years of the useful life. Correct? That was your straight line. The double declining balance has a different thing. It is very close to what we do in taxes, called the Modified Accelerated Cost Recovery System, or MACRS. They call it MACRS. It's basically what this the double declining balance method does is that it charges a lot of depreciation initially and then tapers it off towards the end. So if you have an asset with a cost of 6,000, the initial years of depreciation would be very high, and then slowly, and then as the life increases, the depreciation charge those years will be lower. So it is a it's a reasonably computed method. So first of all, let's understand what it is. The first point to get the double declining balance is to get the straight line rate. The straight line rate is 1 divided by the useful life, or the reciprocal of the useful life. So if the asset has a useful life of 4 years, like in this case, the straight line rate is 25%. Since the method is called double declining balance, so what you do is you get the straight line rate, get the straight line rate and double it. So the double declining balance rate is now 50%. It's 2 times the straight line rate. So if the asset had a useful life of 8 years, then the straight line rate will be 1 divided by 8. And the double declining balance will be 2 times 1 divided by 8, or 1/4. So depending on what the useful life is, the double declining balance rate will also change because it is 2 times the straight line rate. Now, how do we actually implement the 50% number? Well, we implement it as follows. In the first year, we charge 50% because that was our double declining balance rate. We charge 50% depreciation. So the asset cost was 6,000, but this time, very important, you never subtract the salvage value in this method. In the original method, in the straight line, we said the cost minus salvage value, cost minus salvage value divided by useful life. That was the assumption. But in the double declining balance, you don't subtract the salvage value. Okay, you just apply the 50% on the cost itself. So let's see how we do this. Well, the cost of the equipment was 6,000. So we apply 50% of the 6,000. So the first year's depreciation will be $3,000. It will be 2 times what you charged in straight line. So the accumulated depreciation also stays 3,000 because it's the first year. So the book value will be 6 minus 3, or $3,000. Now for the second year, what you do is you take this 3 and apply the 50% on the book value. So the previous year's book value was end of year book value was 3,000. Now apply 50% on that. So the second year's depreciation will be 1,500, and so the accumulated will go from 3,000 to 4,500 because additionally 1,500 was charged. So you now have 4,500 in accumulated depreciation, and the book value therefore now becomes 6 minus 45, or 1,500. Third year, you take 50% of this 1,500. So go further down. So now you take 50% of the 1,500 at 750. So now your accumulated depreciation will become 4,500 plus the new 750, which is 5,250. And so your book value is 750. Now you can see how this goes. If you keep doing the 50%, you can go forever. Because you can go into $1, 50 cents, 25 cents, like that. So, but we know that the useful life is only 4 years. So what we do is in the 4th year, we kind of violate this method. We simply say, okay, the salvage value is 0, so the book value must be equal to 0 at the end of the 4th year, so charge the whole thing off in the 4th year. So in the very last year, we will kind of, we'll violate this assumption. So we'll go that route, we'll apply the formula correctly all the way to the last year, and in the last year, we'll just charge the whole thing off.
So if in last year it doesn't match to 0, then you violate it, right?
No, it's not that. You make it match 0. You're picking this depreciation in the last year, by simply saying that it should come down to 0. So there is nothing to compute in the last year. The last year, so that's where the salvage value will come. Supposing we had assumed that the salvage value was, let's say, $100. Then in the last year, you will charge $650 in depreciation, bring it down to $100 in book value, and it will stay that way.
So also maybe how you look at it, it's always gonna be 50% of the book value of the end of
Previous
last year.
End of last year, except the very last year.
Well,
Yeah.
I'm not trying to get that it has 50%.
Correct. But it's not 50% all the time. It's 50% because in this case, it was 4 years of useful life. So we started with 25 and doubled it.
Understood.
So if let us say the life is 10 years, then you know the straight line rate is 10%. Okay, and so therefore the double declining balance will be 20%. So it will not be 50, it will be 20%. So it's basically the useful life that drives the percentage. Okay? Yes, sir.
Does the cost of maintaining the machine or fixing the machine come into this?
No, it does not. That's a separate item of expenditure called maintenance expenses.
So it doesn't affect the depreciation?
No,
If you're
not at
considering
all.
that machine, you didn't have to do anything to it before it happened?
Not at all. That's a completely separate. Yes, sir.
Now, how do you decide which one to use?
That's totally your choice. So now, clearly, now think about it from a tax point of view, which is better? Double declining balance, because the initial years you depreciate a lot, you pay less taxes, you keep more of your money. So therefore, you keep more of your money early on. But see, in this particular case, folks, everybody, in this particular case, the IRS allows you to use accumulated depreciation, the double declining balance in the IRS system and straight line in the in the investor reporting system. Why? Because in 4 years, it's the same. So they don't, it's not like this is the case where it reverses. So since it reverses, they don't care which method you use in what. Because you know that you are going to pay the higher taxes either now or later. So they don't care that your higher taxes come now versus later. But in the case of inventory, it can become a permanent thing that you are constantly lowering your tax liability on the tax reporting. So they are saying that report the same thing in your investor system.
In your experience, which is mostly used?
Oh, here, in this case, this is all over the place. I mean, I would say that I find that there is more use of the double declining balance in the income tax area and straight line in the financial reporting. Yeah. Okay. All right. So once again, we can ask the question: what if this asset was sold on 1st of July in this particular case? What if it was sold on the 1st of July for $1,000?
And what year?
Say it again.
2005, right? The year.
Oh, okay.
2005, right?
Yeah.
The same thing.
Yes.
So 1st of July 2005, if it is sold, then what you have to do is again you update the accumulated depreciation and the book value. So the accumulated depreciation was $4,500 end of last year. So take the 2005 amount of $750, take half of it. So add to the 4,500. So your book value becomes $4,875, right? Half of 750 is 375. Added to the previous accumulated depreciation of 4,500. So the new accumulated depreciation is 4,875. So your book value is only 1125. See how the book value has changed now? Because you have already charged a lot of depreciation up front. So now the book value is really low. Now you compare this $1125 to the $1,000 cash, you only have to report $125 in loss. Because you've already depreciated it a lot to bring the book value down sufficiently. And so therefore the difference between what you got and the book value is not much. So the loss will change. But again, you can't mess with this system. Because the fact that you've depreciated it a lot, that means you've already sacrificed profits early on. So it's not like you're cheating or anything like that here. It's the same thing. It's going to happen one way or the other. The total expenses, including the loss, will be the same either way. Okay? Any questions on this so far? Because I'm ready to review some questions on the depreciation now. So I want to make sure that you guys are ready for the test on the 28th. So So I wanna make sure that part is complete.
Good, because when you do it, it all comes to life.
Yeah, it will. It will always come to life. There you go. Nice, it's a nice term. So he's bringing accounting to life. Think about that.
You're bringing it to life.
All right. Okay, so let's take some questions here. Number 21. A company purchased land for $84,000 cash. Real estate broker's commission was $5,000 and $7,000 was spent for demolishing an old building on the land before the construction of the new building could start. Proceeds from the salvage of the demolished building was $1,200. Under the historical cost principle, the cost of the land would be recorded at what? What will the land account show?
Asset is recorded at a cost. Total was paid plus necessary.
There you go. So how do we apply that in this particular case? So what we do is we take the 84,000. Okay. So let's see. We'll start with the 84.
Okay, so it's 84 plus 7,000
Yeah, you don't count the commission.
minus 1,200.
Right.
I
So
don't
we
think
have
you- I don't think
$84,000 that was paid.
Uh-huh.
Real estate broker's commission $5,000. You have to.
You would count that, Professor?
Of course.
Without
Without paying the
And-
broker's
Oh, that's
commission,
true.
you won't have the land.
It's true.
$7,000 demolition.
7,096.
7,000 for demolishing the building, absolutely.
Minus 1,200.
Minus the 1,200. Perfect. There you go.
Yeah, that's.
So 84.
It's 84,000.
89,
No.
It's
96.
94. It's 89, and then it's 7,000.
95,
12,000.
Okay, 96
95.
minus
94,800.
Huh?
94,800.
no,
94,000.
94, 94.
So you'll be
Yes.
$94,800.
Mm-hmm.
Right? Is equal to
Use your brain.
$94,800. Right? Everybody okay on this?
Mhm.
Question?
I mean, I understand why and why not, like, why we wouldn't and why we would include the commission.
Yeah, without paying the commission, you won't have the land.
So that's gonna be considered a necessary cost.
Yeah.
Because I can see how it could be considered not a necessary cost because we don't need it.
No, but no, if you don't buy, if you don't, no, point is you don't pay the commission, you're not getting the land.
Yeah, that's like the closing cost.
Yeah,
That's
exactly.
closing
There you
cost.
go.
I guess it's one of those things
It's just the terminology that messes you up because you're
Yeah,
saying commission.
I would agree with you because I guess you can say you can go around paying the commission and that would not be a necessary cost.
But
Actually,
the
Yeah, but now,
commission-
see, no. You're right about that. You're right, but again, now that opens up a whole can of worms. Anytime you buy the asset, you can argue that you could have bought it a different way and saved money.
So you're deflating.
The end of
the-
story right there. I mean,
you're
there is no
deflating.
way you can do anything with that.
Counting for 101.
Because what she says is absolutely correct. If you apply that principle to every asset purchase, then there is no way you can record a purchase at all.
Yeah,
Because you can always come up with saying, oh, you need not have done it this way, you could have done it a different way. But you didn't do it. That's the point. You didn't do it. That's right.
So you're deflating the property value in a way?
What?
Is that a word?
What?
Deflating?
No, you're not deflating.
no.
No. You're recording at what cost you.
No. If
Agree.
we didn't, let's say if we pay so we paid 84,
Mm-hmm.
and then from the other side we paid the other 5,000.
There is no other side in this class. We don't talk other side. There is no other side. So this is there's only one side here, and that is the right side of the law. Okay, so, yeah.
Pretty much add where we had to pay out to equal to.
Your Cuban is
No.
the Cuban.
Right. So if you pay somebody to pay,
Right. Thank God I was
people
raised
that were
here.
most of the way there.
One of those community
Yeah, that's part of the life.
I'm gonna keep going.
Okay, now, guys, this is an excellent question. This is an excellent question. Supposing you bought a piece of property
Mm-hmm.
on which somebody was already living, and exactly, you pay some money to kick them out. That's included in the cost of the property because you can't use it without kicking them out. It's a good point. But I'm hoping that you paid by check, right? So that's the only
You
way you
have
can
proof.
include it.
Pay by check.
So That's
Yeah,
the
like
point.
you
Yeah,
have
Meaning
to.
that it is a recorded thing, right? It can be verified, that's all. Alright, so moving on.
Moving forward.
Okay, they sold equipment for 20,000. It had an original cost of 60 and accumulated depreciation of 30. Ignoring, well, I'm sorry about the spelling of ignoring. Ignoring the tax effect, as a result of the sale, what will happen to profits? So the question is, was there a gain or a loss on the sale? Now, that's very simple in this case because the original cost was 60, accumulated depreciation was 30. So what is the book value? 30. So to get the gain or loss, it is cash on disposal minus book value.
I had a loss of 10,000.
That's it. So the cash on disposal was 20, book value was 30, so they had a loss of $10,000.
Mhm.
So your profits will deflate by $10,000 because you have to report that loss on the income statement.
So C.
So it is what? Net income will decrease 10,000. That is correct. It's at C. Yes.
Yeah.
Okay. So,
Yeah.
Salute.
okay. So let's go to 26. A company purchased factory equipment on June 1, 2014 for $96,000. It's estimated that the equipment will have $6,000 salvage value at the end of its 10-year useful life. Using the straight line method, the amount to be recorded as depreciation expense at December 31st, 2014. This is important. I mean, it's kind of, it throws you off because thinking that there's something important about this December 31st, 2014. But remember, it's straight line. So every year is the same. So all you got to do is to take the original cost minus the salvage value and divide by the useful life.
By 10 years.
So the original cost was 96.
Minus
the
6,000.
salvage value of 6,000. And the useful life was how much? 10.
It's 9,000.
Absolutely. That's
It's
it.
360.
Come on.
What?
Well, unless I did it
Ma-
wrong.
yeah, you did it wrong.
9,000.
No, but you
9,000.
understand the function.
No, I got the formula. I
Okay,
don't know
good,
why. I
good.
just put probably a wrong number in. Let me see.
That happens. Don't
No,
worry.
you know what it was? I think I put 9,000.
Okay, so 96 minus 6 divided by 10.
You're wrong.
So the answer is $9,000.
That's
So
what it
every
was.
year, so the annual depreciation is 9. So whether it is December 31st, 2014, 2015, doesn't matter. Every year it is $9,000 in depreciation.
Yeah.
Mhm.
Yeah, I put 6,000.
So,
Yes. Yeah. Hello, everybody, please. Yes.
So the fact that it was purchased June 1st and December 31st is the end of the year, but it's not quite 12 months.
Oh,
Does it
yeah.
matter?
Perfect. The answer is right. She's right.
Oh, yeah.
Good job.
Somebody is paying attention and it's not me. So thank you very much. That's an excellent point. So it is straight line and it has been in use for how long? Let's see now. June 1st, so only for 7 months in a year. So it will be times 7 12.
So 9,000?
So it will be 9,000 times 7 12.
It is 5,250.
There you go.
Mm.
5,250.
Good job.
That's the answer.
Oh.
The first year's depreciation is only 5,250 because it has been in use for only 7 months. Thank you very much.
For 7 months.
Extra credit.
Extra credit.
See, this is really interesting. She didn't ask for extra credit at all. You guys are already pulling from
Extra credit.
That's nice.
Look out for each other.
That's nice. Very nice. Very good. Thank you. So the depreciation expense for the first year is 22.
So it was important knowing that the 31st December was the date.
That's right. All right. 29. Now I'm going to be careful.
Given too many
Equipment
extra
costing 70,000 with a salvage value of 14 and an estimated life of 8 years has been depreciated using straight line method for 2 years.
Professor, I'm
Yes.
sorry for interrupting.
Not
But
at all.
it shouldn't be 7 months. It should be 5 months.
Why?
Oh, now, okay. Now what happened?
Because I got 3,750 because it's June 1st. So you shouldn't count June 1st, you should count, it should be until May, so it's 5 months, not 7 months.
No, but it was purchased on June 1.
It was
1st. So it has
purchased
been
that
in
day.
use.
So it goes
June
It has been in use from June 1st to December 31st.
You went to the store June 1st.
December.
It has been used for 7 months of the current year.
Oh, okay, that's
This is not a selling thing, it's a purchase thing. So based on the purchase, the depreciation expense for the current year can
I
only
see.
be for
I see.
7/12 of the full year.
You're right.
I see.
Go Cheryl.
No, that was good. I was just, because for the other one, I asked that question on the example. It was 6,000 and they decided to buy
Okay, let's move on.
the equipment June 31st or June 30th. And then it started 7/1/2005.
No, it's not that it
It's a little
started,
different.
it was sold on 7/1, so that means it went away on 7/1. So it was used for 6 months.
For 6 months. That was okay. I see where the difference here is.
Okay, alright, here we go, number 29. Equipment costing 70,000 with a salvage value of 14, estimated life of 8 years, has been depreciated using the straight line method for 2 years. Assuming a revised estimated total life of 6 years and no change in salvage value. So what will be the depreciation expense in year 3? Now this is very common. Sometimes what happens is that you can change the useful life assumption during the life of the asset. Okay, sometimes what you find is that, okay, you've been overusing it, you've been pushing it really hard, so you don't think it'll last, the original assumption. So you can actually change it to a different, number, okay, during the life. But basically what happens is that you fix the depreciation going forward. You don't go backwards and rework the depreciation. So what is already done is done. So going forward, you will use the new useful life assumption in order to compute depreciation going forward. So in this particular case,
And assuming that it's, the total life change was because the equipment was faulty or something?
doesn't matter what. All that matters is that they are assuming that the life has changed. Okay? So now let's take this case. So depreciation, so accumulated depreciation at the end of year 2, because it has been depreciated for 2 years now, right? So at the end of year 2, the accumulated depreciation would be how much? Each year it is 70,000 minus the salvage value of how much? 14? 70 minus 14 is the total amount to be
It's
depreciated.
7,000.
And our original assumption was 8 years. So we
7,000.
assumed it is 8 years, and then we depreciated it for 2 years.
Times 2, 14,000.
So our accumulated depreciation is 14,000. Okay? So the remaining depreciation how much should be charged more? Well, remember the depreciable cost is 70 minus 14 or 56,000. That's the amount of the total depreciation you would charge on this asset. So out of the 56, you've already charged 14. So the remaining depreciation would be equal to the original cost of 70 minus the salvage value of 14, okay, this much, minus the 14 that has been already charged. That's what is still remaining to be charged. So 56 minus 14 is how much? 42?
56.
Yes, 70 minus.
Where do we get 56?
56, right? 70 minus 14 is 56. Minus the 14 that has been already charged. This 14 is a salvage value, folks. So that's the amount, the 70 minus 14 is what
42.
the total depreciation you will be charging. Out of that total, you have already charged 14,000. So 56 minus 14 is how much? 42,000.
42,000.
Okay, so what are they asking here?
It's
The
only the
depreciation
14.
expense for year 3.
It's
So
the 14.
now they have to charge 42,000 more because the salvage value is not changing. But how many years do they have now to charge? Because the
Six.
original assumption of 8
6.
has now been cut down to 6. So and out of the 6 years now, 2 years have already gone. So they basically have 4 more years. So now you are, so annual, so depreciation expense. So therefore, depreciation expense for year 3 would be equal to the 42,000
Minus the 7.
divided by how many years are still left?
6.
4.
You don't have 6 left, you have only 4 left.
So
Because they
half.
changed the assumption from 8 down to 6.
Ah.
And out of 6, 2 are already gone. So you basically have only 4 left. So 42 divided by 4, which is $10,500.
You don't have to.
Wait,
Well, you can do that if you like. I mean, but we didn't start with that. Yes.
okay. So, we originally started with 8 years for depreciation.
Yeah.
And then you used 2 years out of the 8 years, so you had 6 remaining. Is that correct?
Originally, we had 6 remaining.
Originally, you had 6 remaining.
Yes. But then you changed. Okay, go ahead. You finish.
And then it says you revised the estimated total life of 6 years.
From 8, you revised it to 6.
You revised it to 6. So, I guess my question is, since you can't go back to the 8, why not just go forward? Because you already have 6, because you had 6 remaining. You already used it for 2 years. So you had 6 years remaining anyway. So I don't understand why you're going backwards.
No, but it says here, we are not going backwards, it says here, the revised total life is 6. At the end of 2 years, you said that the original assumption of
okay.
8 was wrong, it should have been 6 all along.
Okay.
But what we are not doing is to go back and rework the depreciation we've already
I
charged.
got it now.
So all we are saying is that, okay, starting from now onwards, we have only 4 more years.
Okay.
And your question about the salvage value. The salvage value is already considered in the remaining depreciation. Already the 14 is deducted. So if you do 10,500 for the remaining 4 more years, you are going to get the 42,000 and it will be still left at 14,000 salvage value. So the salvage value is not, we are not violating that. We are still keeping the salvage value at 14. But we said that, okay, we still have, given the 14, we have 42,000 more to go. If you have 42,000 more to go, with 4 more years left, how much would be each year? 10,000. I mean, the one way to kind of intuitively check this out is that so far, your depreciation has been how much? Every year you've been charging how much depreciation? You've been charged 70 minus 14 is 56. 56 divided by 8 is how much? 7,000. So far you've been charging 777, right? But now, since now the life has shortened, you have to charge more. So now you're starting to charge 10,500. You're catching up. Because you now have less years to go than you originally thought. So that's one intuitive way to say that yes, at least even if the numbers are wrong, you're at least on the right track. If you had an opposite way, then you know that you are on the wrong track. Because you have shortened the life, so that means there should be more depreciation charged each year now, because the life is now shorter. Yes?
Professor, the way I understand the way you did it, but I did it another way, and I got the 9,333. And how I did it, I know it may not be correct. I did the 70,000 minus 14,000 divided by 8, so I know that it's every year is gonna depreciate 7,000. So what I did is I added 7,000 times 2 is 14 minus the original 70, and then I divided by 6 years. I didn't take the 4 years, since it's 6 years that we're gonna be that we gave
You
it
have to
a
take only
total.
4 years. That is, you have only 4 more years to go.
But you already used it.
Now, if you go that route,
Yeah, I've only used 2 years, so then I will have 6 years
Yeah,
left.
but you changed the lifespan.
but you change
No,
the
what
life
you
from
change-
8 to 6.
Like, say I gave you
And
this
since-
phone, and originally I said this is 8 years. You can get 8 years out of this, Depreciation. and then you used it for 2 years, and then after them 2 years, I said, never mind. Really, you can only get 6. So you already used 2 of them 6.
Oh, that's what it is.
Yeah,
I see.
but not-
See?
That was.
Thank you.
That was good. That was
You
good.
guys- See, this is this is what I learned.
Cause everybody's staring at me.
He said, I mean, life is really interesting. She said exactly what I said. She said she showed the
But you know,
phone.
the example.
She
the
showed the phone, and that made all the difference. It knocked it
The
down.
phone made the
He needed
difference.
a
That's what I'm
visual. He
saying.
needed a
The thing
visual.
is, some people learn without
There you go.
I learned, that was perfect now. I got it.
Thank you so much. I actually did learn from you. Thank you. Yes.
Putting the board down. Can't see the first one.
This one? This one? Okay.
Yeah. Yeah,
Let me see.
thank you.
So you can explain the problem if that one comes up, but like, yo, how do you do that?
Yes, Shannon, I love it.
The light
that
bulb
was-
went on.
I got it.
Come back
I'm
over here
like,
and tell everybody.
Yeah, you got it, right?
Cause you were
Yeah,
like,
I got it.
I
I
should
got
cook
it.
it. I got it.
Yeah, I still remember it was again in the healthcare MBA program. I think 1 year or 2 years ago, there was one student who basically, you know, like 3/4 of the class was over, and she basically said, you know, you've been doing this. I think I've been trying hard to get it, but I'm a visual person, so I learn visually.
Yeah.
Yeah.
And I'm thinking that a lot of my friends here are also learning visually. So do you mind if I come on the board and explain what you did in a different way? I said, by all means, be my guest, come over here. And all she did, she came and drew a picture. That's all she did. She put a picture in there. And she did exactly, she said it repeated what I have been saying for so long. And that's it, bang, it went through in no time.
Yeah,
I
I
mean,
think
everybody
that's-
was nodding their head and said, yeah, that's what it is.
Yeah.
And so I was telling myself, man, I mean, I wish I could draw better pictures. I mean, I have some really crazy handwriting here. So, yeah, go ahead.
Okay, so I understand that it changed to 6 years and we used to, but at the end it says the depreciation expense for 3 years would be.
Not for 3 years.
Year three.
Year
That's
for
the
year
trick.
3.
If it's in 3 years, that's.
Oh,
That
for
is
year
not
three.
called depreciation expense, it will be
Yeah.
accumulated depreciation.
Then the year had nothing to do with it.
Alright.
Year 3 is that
Nothing
particular
that I know.
year. Okay, everybody good? Alright, so let's go forward.
So we do one more problem and then we go.
You know, I'm, you know, again, as I said, you're you're ready to, or you're allowed to walk out at any time. Believe me, I really mean it when I say this. Just do it quietly.
People laughing.
You can do it quietly, I have no problem at all. So you can go anytime, but I'm going to do what I think is necessary
Of
to
course.
get you ready for the test.
Thank you.
Thank you,
So-
Professor.
So we will just, you know, today.
Yeah, I never do, but I have to.
Okay, now this is going to be a more complicated, I mean, a kind of more, I'm going to go back to inventory because it's, oh, okay, by the way, so let me now talk about the test. Maybe I should take a problem from the book. So let me take an example.
Like the hardest one, so we
The hardest one?
No, it's really not the hardest or anything.
some things are very challenging, so that will
Something that's will be on the test.
Yeah.
Yeah, I'll probably take
Challenging
something.
enough so we prepare.
And assume that you use 2 years, that's really right.
No, you have to take out the initial 14,000 from the 7,000.
Because you already consumed that one.
Then you was gonna hand it in.
It's a visual concept.
You work well.
What did you guys say about that, about the last part? The depreciation expense for year 3 would be your question? What did they say about that?
No, I was confused, I was looking at it for 3 years, and what is year 3.
Okay. Okay, I think this may be a good problem to look at. Let's see now. Page 491.
Nobody has that book. One, two.
I didn't bring it.
Oh, and of course, Mom.
I have it.
Okay, page 491.
That's the end. Oh,
And
that's the end.
page 491, problem B978.
You don't want your book, right?
Some of us don't have the book.
B978. Okay? let's look at, page 491, problem P978. Okay, they purchased 3 machines. Because of frequent employee turnover, a different accountant was in charge of each machine, and so basically they've been using different methods for the different machines. So let's focus on 1 and 2. 3 I've really not done. I'll finish it on when we meet on 28, but I won't put a question on that on the test. So let's not do units of activity. I'll complete that later on. So 1 and 2. On January 1, machine 1 was purchased on January 1, 2012. At a cost of 96,000, salvage value was 12, useful life was 8. It was depreciated using straight line. The question is, compute the amount of accumulated depreciation on each machine as at December 31st, 2015. Okay, so in the first case, so your the cost of the machine. Sorry, that's okay. That's okay. The cost of the machine was 96 and the salvage value was 12, and the useful life was 8. 96, 118. So 96,000 minus 12,000 divided by a useful life of 8, that would be the annual depreciation. Okay? And it was purchased on January 1, 2012, and they want to know how much is the accumulated depreciation at the end of 2015, right? So 12, 13, 14, and 15, so 4 years. So the total accumulated depreciation would be 4 times this. This is what is depreciated each year.
42,000.
Right? So it will be, the answer is 42?
Yeah.
So it will be $42,000. So that will be your accumulated depreciation as of December 31st. Because now you're not doing annual depreciation, you're looking at accumulated depreciation at the end of 4 years. So after depreciating it for 4 years, your accumulated depreciation would be $42,000. Then they want to know, in the second case, was being depreciated using double declining balance 5 years on each machine. So now for the double declining balance, we'll probably have to set up a schedule. So we'll go through that. So we'll start with year, then depreciation expense, then accumulated depreciation and book value. Okay? So since it was, when was it purchased?
It was purchased.
Machine 2 was purchased
2013.
but July 1. So we'll start with 2013.
What do you have up there? Do you have year, depreciation?
Depreciation expense, accumulated depreciation, and book value.
All the way to.
Okay, the same way the Excel sheet was set up. Okay, but since it is double declining balance, we'll have to go through this table a little bit.
50%.
So now in 2013, so first question is, how much is the, for double declining balance, first remember we need to get the straight line rate. What was the useful life for the machine 2, second machine?
Thank you.
5.
5 years, right? The useful life for machine 2? 5 years. So straight line rate would be 1/5. So therefore, the double declining balance rate would be equal to 2 times 1/5 or 40%. Correct? Because 1/5 is 20%. So 2 times 1/5 is 40%.
Yes.
So in 2013, your depreciation expense would be 0.4 times the original cost. What was the original cost of that?
85,000.
85,000.
Yes.
But it has been in use for only 6 months. So take half of that. Because it was bought only on July 1st. So in 2013, your depreciation expense, this is the whole year's thing, 0.4 times 85,000. But since it was in use for only 6 months that year, so it will be 85 times 0.4 divided by 2. Because it's for only 6 months.
half a year.
0.4 times 85 is for the whole year.
I mean, you get the check.
But since you had the equipment in use for only 6 months, you take half of that. So how much is this coming out to?
17,000.
17,000.
First, I'm not getting that part. 0.4 times 85,000 divided by 2.
See, if you had it on January 1st of 2013, this would be it.
Right.
But you didn't have it on January 1, 2013. You had it only on July 1, 2013.
So only half of the year, so that's why you get the
So
2.
therefore, you have only 6 months left that year.
6 over 12.
Okay.
So that's why you divide it by 2. It's only for, it's been there for only half the year. So take the full year's depreciation under that method and divide it by 2 because it's been there for only half a year.
What was that, 17?
That's what she says. So $17,000 is the depreciation expense for that year. So your accumulated depreciation is also 17,000. So how much is your book value? Book value will be 85 minus
Minus 17.
How much?
One side.
68?
68,000.
So book value would be 85,000 minus 17,000, which is equal to $68,000.
Professor?
Yes.
Going back to the first one, why did you use 4 years? Because you started in 2012 and
Yeah, this is the end of the year 2015.
you went all the way to 2015?
Yeah, 12, 13, 14, and 15. 4 years. Alright, so now for 2014, you will do, this is now the whole year, right?
The whole year.
So it will be 0.4 times 68.
Times
So how much is it?
68,000. It's 27,200.
Thank you. $27,200. So the accumulated depreciation will be 27,2 plus 17, which is 44,200.
Uh-huh.
Correct?
Yes.
So the book value will be 68 minus 44,2 minus 40.
23,000.
No, my mistake. It will be 85 minus 44.
Oh.
Book value is always the original cost minus accumulated. So 85 minus 44,200.
It's $40,800.
So $40,800. Correct? That is as of December 31st, 2014. So now, what about 2015? Because we want it at the end of December 31st, 2015. So for the depreciation for 2015 would be 0.4 times the 40,800. How much is that?
40 times 4. 16,320.
16,320.
So 85,000.
So now, if you add
minus-
that here, this will be 520, 44 plus 16 would be 60.
44.
So it will be 60,520, correct? The accumulated depreciation?
Yes, sir.
Okay. So now
Minus
you
85,000.
good. Minus?
85,000.
Minus what?
Minus 6,000.
16.
Si-
320.
16,320.
60,520. So that's how much?
Oh,
Accumulated depreciation.
yes. It's 24,480.
24,480. Good.
Can you walk me through that again? So you got the 16,320,
Yeah.
and the current
The accumulated depreciation is this plus the 16,320. So 60,520. And then the book value is 85 minus the accumulated depreciation. So 24,480. Is that what they're asking?
Oh, that's 2014. This entire time I thought the one on 13 was, I thought I said 2016. I'm like, what? The years.
No, this is
Yeah.
20.
No, 'cause
We started in
it's
2013.
What time?
They want to know the book value at the end of 2015, correct?
No, I was confused myself because I thought that said 2013, 2016, and 2015. But that I confused that 4 for a 6. I don't know, you're okay, Professor.
I'm okay, right?
Yeah, no, I confused this number for
You're
a
good.
6 over there.
Oh, okay.
That's why.
Okay.
I was lost for a second. I was like,
Accumulated depreciation, yeah.
Oh, yeah, for
60,000 is the previous accumulated depreciation plus the new. This 44,200 plus the 16,320. That is 60,520. Okay. So now your book value is 24,480 based on this method, correct?
Yes.
Yes. Yeah, for machine 2, correct. Because it was bought at a different date. That's why 2012 doesn't show up here. But it was only purchased in 2013. So it's a separate problem altogether. Question?
We wouldn't, no, I already figured it out. I already asked
Okay,
no
good.
question.
Good. Okay. So now, what is their next question? They're asking something else too.
No, I'll show you the later.
If machine 2 was purchased on April 1 instead of July 1, what would be the depreciation expense for this machine in 2013 and 14? Basically, you got to recompute it based on 2013 and 2014. So 2013, you would not be dividing it by 2. You would be multiplying because it was purchased on April 1. So that means it will be 9 12. Instead of 6 12s, it will be 9 12s. So you would do 0.4 times 85 times 9 12s to get the depreciation expense here. Then it will all transfer. So once you get this, the book value, then the new book value will be 0.4 times that. And so the second year's depreciation would also be different. Okay. So you want me to do that?
Yes.
Okay. So let's do this. Let me erase this, erase this.
We do all over again?
No, not all, because they asked for only 2 years. They want to know what is the depreciation expense for 2 years. Okay. So here we go. So we take the first year's is 0.4 times 85. Correct? Times how many months in that year has the equipment been in use? 9 months. So you take 0.4 times 85 times 9 months. How much is that? On
I'm
April
lost.
1, right?
I'm lost.
So that means April through December. That's 9 months.
9 months.
So how much is this?
0.4 times 85,000. No, yeah. Times 9 divided by 12. 25,500.
$25,500. So your accumulated depreciation is the same, 25,500. So the book value is 85 minus 25,500, and that is equal to 59,500.
59,000 pounds.
9 divided by 12 is 75%, right? So 34,000, which is 24 times 85,000. I got, oh, okay.
So you have $59,500 is the book value at the end of year 1, correct? So the year 2 depreciation, the 2014 depreciation would be 59,500. Now this is for the whole year, times 0.4. You don't have to worry about it. So the depreciation expense for 2000 so the answer to that question would be for 2014 the depreciation expense is 25.5, and for 2015 it will be 59.5 times 0.4. How much is that?
1 second. 59,500.
23.8. So it will be $23,800, right? 59.5 times 0.4.
Plus 25.
25.
No, why plus 25?
Because the
Because they're
accumulated.
not asking accumulated depreciation. They're asking just the depreciation expense, right?
Oh, okay. That makes a difference.
So the depreciation expense for the year is only 23.8. But the accumulated depreciation at the end of the year, if they ask that question, it would be 25.5 plus the 23.
Okay.
48, where is 8 coming? No, it should be 49.3. 25.5 plus 23.8 is 49.3. So it'll be 49,300 will be the accumulated depreciation at the end of the second year. But that's not what they're asking. They want to know how much will be the depreciation expense in the first year and in the second year. First year, you have to make sure that you deflate it by multiplying it times 9 months. Right? Any questions on this?
You meant 5,000 right there at the end? You meant that was
So the,
not an extra zero, right?
Thank you. Thank you very much.
so the two answers,
Right. Thank you very much. 59.5.
Professor, so
Yes, sir.
the answers will be the 25,500 for 2013 and then 23,000.
3,800 for 2012.
It was 49,300.
That will be the depreciation expense. Okay, yes.
Accumulated depreciation, for 2014 will be the 25.
Not for 2014, at the end of
At the end,
2014.
sorry.
The moment you say accumulated depreciation is at a point in time.
Understood. At the end of 2014, accumulated depreciation will be 25,500 plus the 23,800, right?
Yeah.
Okay, cool.
All right. No more new work. So let me just now talk about the test first, and then I'll talk about the things that I'm going to send you by the end of the day today. First, first the test. The test will have a total of 8 multiple choice questions and 2 workout problems. Okay? The 2 workout problems will be kind of similar to what we have seen now. Like for example, I might ask you to compute depreciation for 1 or 2 years, and then say if it was sold at this date, how much is the gain or loss, something like that, on the depreciation question. On the inventory question, the same thing. I'll give you the inventory numbers and I'll say how much it is, how much is the ending inventory using LIFO, FIFO, whatever method it is.
Average cost.
Average cost, or whatever method I might choose to do. Okay? So there'll be one workout problem inventory, one workout problem using inventory, and one workout problem on depreciation. 2 workout problems. And then there will be 8 multiple choice questions, 4 from chapter 9 and 4 from chapter 6. Okay, so total of 8 multiple choice and 2 workout problems. You don't get any partial credit on multiple choice. I don't need to see your work. So just, the answer is either right or wrong. And the 2 workout problems, you do get partial credit. If you have attempted the question, and logically proceeded, you will get credit for the work that you did logically. Only 6 and 9, nothing else. So that'll be chapter 6 and chapter 9, yes.
Can you give us extra credit?
No extra credit.
Like a very challenging question for extra credit.
The extra credit would depend upon how the course goes. So on your second test, the take-home test, I may put an extra credit depending upon how you all did in the first test. So therefore, if I think that you could do with an extra credit, I will give it to you with the take-home test. That way you will have the time. The time is not a constraint. Here I put the extra credit, and the time becomes a constraint for everybody. So therefore, not on the first test, but on the second test, possibly that may be an extra credit. Okay, that's number 1. Second, what I'm going to be sending you, hopefully by the end of the day today, would be instructions on your ratios analysis project, the financial analysis project. That instruction would also include the assignment of the company for each group. I believe there are 7 groups in this class, so there'll be a company assigned for each group. In each case, you have to compute or you have to do the project for the company that you're assigned. But what you're going to do is that you're going to compute the ratios, the defined ratios, for your company as well as a competitor. So I will assign both your company and the competitor for which you are, so I will do the company assignments for every group. Okay, and I will also send you a sample report, which has been recently submitted, and that should serve as some kind of a guide. The sample report might have my own comments on it. I don't think there are much, but there will be some comments. So that might also help you, to see what is it that I'm looking for. Okay? So it'll have your company, your competitor, and your, the